Hello and welcome to another episode on futures and options. I am Kushal Lodha, founder of Kager, an education company in financial literacy. And today I am excited to discuss rollover strategies in futures and options and how traders can effectively use them to their advantage.
Let's start with the basics. What exactly is a rollover in futures and options trading?
Sure, a rollover in F&O trading refers to the process of closing out a position in a near-month contract and simultaneously opening a position in a far-month contract. This allows traders to maintain their market exposure without having to square off their position at the end of the contract's expiry.
Wow, that's a great analogy. Why would a trader want to execute a rollover?
Traders execute rollovers to extend their position's duration and take advantage of expected future price movements without closing their existing position. This can be particularly useful if a trader believes that the trend will continue beyond the current contract's expiry. For instance, if a trader holds a long position in index futures and expects the index to rise further in the next month, they can roll over their position to the next month's contract to stay invested in the market. They also generate rollover return if rolling over increases the value of their existing position.
And how do traders determine the right time to execute a rollover?
Timing a rollover is extremely crucial. Traders typically look at factors such as the cost of carry, liquidity, and market sentiment. The cost of carry includes the interest cost and dividend yields that impact the price difference between the near month and far month contracts in underlying assets such as stocks. For example, if the cost of carry for rolling over a futures contract is low, it may be advantageous to execute the rollover early. Additionally, traders should monitor liquidity to ensure they can enter and exit positions without significant price impact.
Can you explain the cost of carry with a numerical example?
Of course, let's say you have a long position in a futures contract on stock X that is currently trading at Rs 450 per share. The price of a future on this stock is Rs 455. The cost of carry in this case is futures price minus spot price, which is equal to Rs 455 minus Rs 450, which is Rs 5.
How about liquidity? Why is it important for rollovers?
Liquidity ensures that there are enough buyers and sellers in the market for you to execute your trades without significant price changes.
Okay, can you walk us through the steps involved in executing a rollover with an example?
Absolutely. Let's say you have a long position in futures of stock X expiring in July. Here's how you can execute a rollover to the August contract. Number 1, evaluate the current position. You hold 100 lots of stock X futures currently trading at Rs 1,500 per share. Number 2, check the cost of carry. The July contract is priced at Rs 1,505 and the August contract is priced at Rs 1,510. The cost of carry is Rs 1,510 minus Rs 1,505, which is Rs 5 per share. Number 3, analyze liquidity. Ensure there is enough volume in the August contract. Let's say the August contract has sufficient trading volume. Number 4, place rollover orders. Place an order to sell 100 lots of the July contract at Rs 1,505 and simultaneously buy 100 lots of the August contract at Rs 1,510. Number 5, monitor the market. After executing the rollover, continue to monitor the market for any significant changes in price, volatility, or news that could impact your position.
That makes a lot of sense. Let's dive deeper into specific rollover strategies. Can you explain some of these strategies with examples?
Sure, let's go through a few popular rollover strategies. Simple rollover, spread rollover, hedged rollover, partial rollover, and cost averaging rollover.
Wow, this sounds like a lot. Can you start with the simple rollover strategy?
Sure, a simple rollover is straightforward. You close out your existing position and open a new one in the next month's contract. This is the most basic form of rollover. For example, let's say you have a long position in stock A, futures expiring in June, currently trading at Rs 1,600. You decide to roll over to July. So what will you do? Sell June contract at Rs 1,605, then buy the July contract at Rs 1,610, The cost of carry here is rupees 5, which is rupees 1610 minus rupees 1605 per share.
And what about the spread rollover strategy?
In a spread rollover, you look at the price difference, which is spread between the near month and far month contracts, and make your rollover decision based on that. For example, you have a long position in stock B's futures expiring in June, currently trading at rupees 2000. The June contract is priced at rupees 2005 and the July contract is priced at rupees 2015. You will evaluate the spread. The spread between the June and July contracts is rupees 10, which is rupees 2015 minus rupees 2005. And then you will execute the rollover. If you find the spread reasonable, sell the June contract at rupees 2005 and buy the July contract at rupees 2015.
Okay, and how does a hedged rollover work?
A hedged rollover involves using options to hedge your rollover position, reducing the risk of adverse price movements. For example, you have a long position in index futures expiring in June, currently trading at rupees 15,000. You decide to roll over to July but want to hedge against a potential downside. You will sell the June contract at rupees 15,005, then you will buy the July contract at rupees 15,015, and then you will hedge with options. You will buy a put option for July at a strike price of rupees 14,900. This option might cost you rupees 50 per share, and the cost of the hedge is rupees 50, which provides downside protection.
Well, I think you should explain us the partial rollover strategy too.
In a partial rollover, instead of rolling over your entire position at once, you roll over portions of it over several days to minimize market impact and slippage. For example, you have a long position in stock J's futures expiring in July, currently trading at rupees 1,500 with 200 lots. Instead of rolling over all the 200 lots at once, what will you do? On the first day, you will sell 50 lots of July contract at rupees 1,505 and buy 50 lots of August contract at rupees 1,510. On the second day, repeat the same process for another 50 lots and continue until completion. Spread the rollover over 4 days. This way you reduce the risk of moving the market price significantly.
And what about the cost averaging rollover strategy?
Cost averaging rollover involves averaging the cost of your rollover by executing it at different price points, which can help manage risk if the market is volatile. For example, you have a long position in stock E's futures expiring in June, currently trading at rupees 450 with 100 lots. The first rollover, sell 33 lots of June contract at rupees 452 and buy 33 lots of July contract at rupees 455. Then there will be a second rollover, sell another 33 lots of June contract at rupees 454 and buy 33 lots of July contract at rupees 457. And then the final rollover, sell the remaining 34 lots of June contract at rupees 456 and buy 34 lots of July contract at rupees 458. By averaging the rollover prices, you mitigate the impact of short-term price volatility.
Wow! TMI Kushal. These are some excellent strategies. But can you provide a recap?
Sure. Let's take the example of a trader who had a long position in stock C's futures expiring in June. The trader expected the stock to continue its upward trend due to strong quarterly results and positive market sentiment. You will first evaluate the position. The trader held 50 lots of stock C's futures currently trading at rupees 1,600 per share. Then you will check the cost of carry. The June contract was priced at rupees 1,605 and the July contract was priced at rupees 1,610. The cost of carry was rupees 5, which is rupees 1,610 minus rupees 1,605 per share. Then you will analyze liquidity. The trader checked liquidity in the July contract and found sufficient volume to execute the rollover without significant slippage. Subsequently, you will place rollover orders. The trader placed an order to sell 50 lots of the June contract at rupees 1,605 and simultaneously buy 50 lots of the July contract at rupees 1,610. And finally, you will monitor the market. After executing the rollover, the trader monitored the market for any significant changes. Stock C's positive earnings announcement resulted in a continued uptrend validating the decision to roll over.
That's a great example. Any final thoughts for our listeners on executing effective rollover strategies?
Just remember that rollovers are not a one-size-fits-all strategy. They should be tailored to your market outlook, risk tolerance, and trading goals. Always conduct thorough analysis and consider the cost of carry, liquidity, and market sentiment before executing rollovers. Additionally, stay disciplined and avoid emotional decision making. Rollover should be part of a well-planned trading strategy and not a reaction to short-term market fluctuations.
Thank you so much for sharing your expertise with us today. Kushal, I'm sure our listeners have gained valuable insights into executing effective rollover strategies for futures and options.
Thank you for having me. It's been a pleasure discussing these important topics with you.